How's everyone, guys? Is everyone all right? So, did you guys attempt the question? So, like, did you find it easy or difficult? Was not difficult, it was doable. Okay, perfect. I have no idea. I will solve with you people. Then I will tell that it is difficult or easy. But let's start it. Yeah, let's start it. So, we will do this question number one and next week. I think this is the question, yes. Let's start from the requirement. Calculate for the two scenarios. Calculate for the two scenarios the funding required for the acquisition of Pymore company, more like Pymore company. Funding required. The impact on Melplash company EPS. The impact on M company gearing. So we need to calculate the impact on the gearing, EPS, and the funding required. This question is more similar to the Lloyd company. If I correctly remember, one of the requirement in the Lloyd company was quite similar to this. The key B part. If the acquisition was to take place, discuss the concern that M company shareholder may have about the EPS, gearing level, and the control of the company. C part, discuss the regulatory and governance concern relating to the promises required by Peter and Patrick. Professional marks will be awarded for the demonstration of skills in analysis and evaluation, skepticism, and commercial equity. So let's read the required scenario. M company is a leading bus operator in Vesnia, operating bus services in the country's south and central region. M company board is keen to expand its bus operation into the other regions of the country and also would like to gain franchises to operate trains on Vesnia rail network. So previously you are in bus, now you also want to operate on trains. M company board has identified Pymore company as an appealing takeover target. Pymore company operates bus services in Vesnia north and east region. So you are in south and central. The other company is in north and east region. So it will create a synergy and also a franchise to run local train service in east region. Pymore company, in common with other rail companies, has recently faced pressure from the Vesnia government to enhance investment in its trains and staffing in order to increase customer satisfaction. M company board believes that Pymore company will struggle to meet these demands with the resources it has, and therefore its director will be open to a takeover offer from M company. So M company board believes that Pymore will struggle to beat. So if we acquire them, so we can do this. On standalone basis, Pymore company will not able to meet this. Both companies are listed on Vesnia Stock Exchange. M company has a range of institutional and smaller investors with no shareholding more than 12% of share in the company. On the other hand, 45% of Pymore shares are owned by the brothers Peter and Patrick, who are respectively chief executive and operations director of the Pymore company. So major chunk of the Pymore company are with the two brothers. Reaction to the acquisition. M Company board believes that its investor will be concerned about future earning per share if the acquisition goes ahead and how earning per share might differ between the two possible scenarios which the board envisages. They would be sensitive about any increase in the gearing level. Shareholder would be sensitive, and the implication of for the control of the company of introducing new shareholders. So if there is a change in the control, so that would be a major concern for the shareholder plus the gearing. The both brothers have discussed between themselves the possible terms of an offer from M Company. They have decided that they would consider accepting a share offer provided they were promised executive directorship on the combined company board with a package at least equivalent to what they were currently receiving and services contract for 3 years. Any financial impact of the Telham becoming executive directors should be ignored in the calculation. So we will write this assumption as well. Okay, the next is, these are the extract profit before finance cost and tax, interest and tax, to be honest, PBIT. Finance cost, PBT, tax, profit after tax, nominal shares are given, earning per shares are given, PE ratio is given of the both companies. Market price per share is given, long-term liabilities are given, gearing is given, long-term liabilities divided by debt plus equity on market value basis. Cash and cash equivalent is given, industry average gearing is 34%. Okay, the next is, okay, nothing. M Company board is considering, I am considering giving Pymore Company shareholder the choice between 2 shares in M Company for 3 shares in Pymore Company or a cash alternative of $2.7 for each Pymore Company share. M Company board is contemplating 2 possible scenarios. All Pymore Company shareholder accept the cash offer. All Pymore Company shareholder accept the share offer. But you can also discuss about the mix offer. Annual post-tax synergy from the merger are expected to be 8 billion per year. Combined PE ratio is expected to be the same as M Company was before the acquisition. Cash payment for shares will be funded firstly by the balance of cash and cash equivalent held by the M Company. Assume that return on cash surpluses which M Company could make is 6%. So if you are paying in cash, you will use your own cash surplus. And remember, your current opportunity cost of cash is 6%. That means you have already invested this 102 million at 6%. So if you use this for the acquisition, you will lose the income. Balance of the cash requirement for the cash payment for shares will be funded by debt at a pre-tax cost of debt of 9%. Assuming existing debt of Pymore Company will be taken on by the M Company and not paid off using the balance of cash and cash equivalent. And that Pymore Company balances of cash and cash equivalent will be maintained in the merged company. Tax is payable at annual rate of 25% on the profit of both companies. So that is a question. So let me read the requirement first. Calculate for the 2 scenarios, and we have to calculate the impact on 3 things: funding required, EPS, and gearing. So let's solve it one by one. Let's open the spreadsheet. Part A. Okay, what was the requirement? For the 2 scenarios, funding required, EPS, and gearing. Scenario number 1. Okay. Funding required, impact on EPS, and what was the other? Impact on gearing. Impact on gearing. Okay. So what is the first scenario? Cash. Cash offer. Okay. What is the second scenario? Share offer. Okay. Share offer. So let's discuss one by one how much cash you need. So in cash offer, you will pay $2.75 for one share. How many shares of that company? 150 million. Issued $1 nominal shares, 150 million. So you will pay cash required shares 150 million into 2.75. 412.5. Okay. You can also add one more point here. All figures are in dollar million. So cash required is 412.5 million. Cash available. So how much is the available cash? 102 million. We will not use the cash of the target company. We will use our cash. Cash available 102 million. 102 million. So funding required is 412 minus 102. So this is the funding required. 310.5. So when you are acquiring any company through share offer, funding required will be nil. Because share offer means you will issue your shares in order to acquire the other company. So funding required would be nil. Okay. Now, what is the impact on the gearing? Let's calculate the combined earnings first. First of all, what is the earning of parent company? Parent company is M company and earning is 0.3 million. Okay, shares. Earnings. Okay, then shares of other company, Pymore. EPS of Pymore. And earnings of Pymore. So let's quickly put the information. 200 million, 0.3. 200 million and 0.3. 200 million, 0.3. So earnings are 0.3 into 200. Okay, shares are 150 million and 0.22. 150 million, 0.22, 0.22 into 150 million. Okay. Now, what is the synergy? It was also given. Synergy was, I think, 8 million. Synergy was 8 million after tax. After tax synergy. 8 million. Okay. What is the impact? If you use the cash to acquire the other company, the income which you used to earn on the cash balances, you will lose that. So opportunity loss on cash. So how much you used to earn? 6%. You used to earn 6%. Pre-tax. And tax is 25%. So you will lose 102 into 6% into 0.75. And additional loan, additional interest, you will borrow 310.5 from the market at 9% into 0.75. That would be the after-tax interest. So combined earning will be earning of M company, earning of Pymore, plus energy minus opportunity loss minus additional interest. So these are combined earnings. Okay. Combined shares will remain same because it's a cash offer. Combined shares will be same of parent company. So what would be the EPS? Combined EPS. 75 divided by 200. So 0.377. That would be the combined EPS. Approximately, you can say that 0.38. Okay. What would be the impact here? What would be the impact here? Here, previous earning will remain same, but there is no need to pay additional interest. That would be 0. You will not lose any opportunity loss on the cash, but your shares will be higher. Your shares will be higher. Here, you will issue new shares. Existing shares of M company, that is 200. Existing shares of M company plus new shares. Okay, how much new shares you have to issue? It is written. For 3 shares of Pymore company, you have to issue 2 shares. And how many shares of the Pymore? 150. So new shares will be 150 divided by 3 into 2. So what are the number of new shares? 300 million. So 101 divided by 300. That would be 0.336, or you can say 0.34. 0.34. Okay. That's how you will solve it. Similarly, let me do this here. Now let's calculate the impact of gearing. Then we will calculate. Then we will discuss if there is any question here. Okay, gearing. Formula is debt divided by debt plus equity. Equity and total capital. Then you will calculate the gearing. So here, what is the old debt? Let's collect the old debt. 285 plus 225. 285 plus 225. 285 plus 225 plus the new debt. How much debt you are raising? 310. So 820 is the new debt. But here debt will remain same. Here debt will remain same. Okay. Okay. In equity, take the combined EPS with the combined PE ratio. PE ratio of the parent company will remain same, that is 13.2. 13.2 into combined number of shares, that is here 200. Okay. And here combined EPS into combined number of shares into combined P ratio, that is 13.2, because it is written that P ratio will remain same. Okay, total capital is, add these two. Gearing is debt divided by total capital. %27 and 45.17%. 27 and 47, 27 and 45%. That's how you will do it. So this is a gearing. By the way, also write the current gearing. Obviously, group gearing is 26.5 and 38. Current gearing of and Pymore. 26.5 and 38. 26.5% and 38%. And the EPS, current EPS is 0.3 and 0.22. Current EPS is, let me write here. Current EPS is 0.3. So EPS is rising in both cases. 0.3. Okay, that's the numeric part which we have solved. Was to take place, discuss the concern that M company shareholder may have that. Part B. Concerns, starting with the earning per share. Okay. If M company acquires this company, what would be your concern about the EPS? So it was written somewhere. It was written somewhere. M company board believes that an investor will be concerned about future earning per share if the acquisition goes ahead, and how earnings per share might differ between the two possible scenarios which the board envisaged. They would be sensitive about any increase in gearing and implication of control, but obviously they are concerned about the future earning. So let me discuss. What is the current EPS? 0.3, right? And EPS is rising both in cash and share offer, but more in cash offer. More in cash offer. In both cases, EPS is rising compared to current current earnings per share company, that is $0.30 per share. In cash offer, EPS is higher at 0.38 compared to share offer EPS $0.34. Right? So in both cases, the EPS is rising. So what would be the concern of the shareholder? In both cases are acceptable scenarios. What should be the concern? However, there should be some concerns of shareholders regarding risk of both methods and actual realization of this earnings. In cash offer, company is raising more debt from current level and using its cash balances, leading it to a risky position. And in share offer, company is issuing more shares to new shareholders, leading to dilution of control, which may not be acceptable to shareholders, old shareholders. Okay. There can be another concern of shareholders about the actual realization of post acquisition earning. Which is just an estimated figure now. Estimated figure now and depending upon future. Okay, right? Anything else? Any other concern of shareholder regarding earnings? There are chances of increase in revenue as both companies are operating in different region, plus in post-acquisition scenario, rail system is also included. However, there is no information about the increase in operational cost or operational expenses, operational cost and operational integration difficulties which this group will face in post-merger scenario. You will also discuss about that there is no merger cost given. You can also include that because nothing is given in the question. Then gearing. Okay. Next is gearing. In both cases, current gearing is 26. In both cases, it is rising, but in share offer, it is marginally rising. In both cases, gearing will rise compared to current scenario. Okay, what is the in current? What is the gearing? 26.4. 26.4. 6.4 scenario. To 45% in cash offer and 28% in share offer. In share exchange offer, however, there is only a marginal rise in gearing. Marginal rise in gearing. Which is not a concern for shareholders. Which may not. But in cash offer, gearing has significantly increased to 45% level. And if this is higher than industry average, this would be a concern for existing shareholders. Okay. shareholders will be concerned about the new level of debt, its terms, interest rate, and repayment scenario. And because of this, required return of shareholders will rise in this case. Okay. So what should we do? Either company should raise long-term debt at reasonable rate to address the concern of shareholders, or issue right shares to raise funds and pay the Pymore company shareholders. The issue with this suggestion is all shareholders may not participate in right issue, and company has to move to external shareholders and it may dilute shareholder. Okay, so that's how you will write. The last you will write about the control of the company. Obviously, in cash offer there will be no dilution of the control, but in share offer your control will be diluted. You can write that how much your control will be diluted. In cash offer you will write there will be no dilution, but in share offer there will be a dilution. Like let me guide you here. Previous shares are 200, new shares are 100. So if I take the calculation, previous shareholders are now 67% owner of this company. So they have lost 33% shareholding of the company. Okay. 33% shareholder of the company. So almost one third shares will be issued to the new shareholders. And out of those one third shareholders, majority will be paid to the two directors. Remember, here it was written that 45% shareholding was given to two directors. So those two directors has a 45% shareholding. So out of 300, 45 shares are held by two shareholders. So 15% control of the company is held by two shareholders. This is alarming. Why, sir? Why it is alarming? Because if you look at the structure of the company, look at this. Both companies are listed on Westnia Stock Exchange. M company has a range of institutional and smaller investors with no shareholder holding more than 12% shares. So M company largest shareholder holds only 12%. But after the acquisition, if we go for share, its largest shareholder will be 15% shareholding. So those two directors can declare control of can declare their control on the company by making arrangements with other shareholders. So this is alarming for the M company shareholders. So you will also write this because they're both of these two shareholders have the highest shareholding compared to all other shareholders. They are holding 15%. So if they engage any other 1 to 2 shareholders, if they declare their majority shareholding, they will appoint the directors and they will control the company. So this is problematic. You will write this in the question, okay? Okay. So then you will write the last point. That is, what is the last point? Discuss the regulatory and governance concern relating to promises required by Peter and Patrick. Peter and Patrick. Part C. First of all, we'll discuss regulatory concern. It is a regulatory requirement that any offer is made to one to few shareholders of target company. It should be made to all shareholders. Remember the statement from the regulatory requirement chapter. Should be made to all shareholders without any discrimination. However, in this scenario, Talham brothers are dealing with company for their board seat compensation and long-term contract in new company. This is against the principle of equal treatment. Okay, this is the principle of equal treatment. Of all shareholders. This process of offering any new role to Tulham brothers or any or new shareholding in combined company should be transparent and open and disclose to all shareholders. And their offer should be comparable to other shareholders. Okay, right. So this is the main concern, regulatory concern. So what is the governance concern? What would be the governance concern? Governance concerns are there is a conflict between Filham directors' personal interest and all shareholders' interest. These directors should act on behalf of all shareholders instead of deciding their own new roles. If the new offer is beneficial for shareholders, these directors should convince all shareholders, and if new offer is not beneficial, these directors should guide the shareholders about the problems of this offer. They should not act on their own personal interest and leaving behind the benefits of shareholders. Okay, there's a governance concern. So the remaining shareholders can question on this acquisition deal that how acquirer can offer more generous terms to two shareholders and not to all shareholders. Okay. For example, board seat, compensation, and long-term contract. You can ask this question. Right? This may be the question in local governance requirement. Right? So whatever your governance like, the governance requirements of every country is different. But this act, this conflict of interest can be questioned in any governance requirements. That why you are treating two shareholders more generously compared to the other shareholders. Why you are giving favorable terms to few shareholders compared to the other shareholders. This can be a question. This will be the question local governance requirements, and this deal can be challenged according to local governance body. So I have written this generally, but it depends. It depends upon local body to local body. Okay, that's how you will write it. Actually, funding required for acquisition, Pymore, number of shares, PE ratio, market value of equity, combined market value equity, कैसे आ गया ये? Combined earnings, energy. गेन लॉस तो पूछा ही नहीं मेरे भाई, ये क्या कैलकुलेट कर दिया? What you have calculated? Did examiner ask about the gain loss? No. So this was not required, by the way. चलिए कैश पेड ये ठीक है, दिस इज ओके. कैश लोन, what is this 0.91? Why you are grossing it up? What is this? This is totally wrong. Earning per share, total loan. यानी वेल इंटरेस्ट क्या होता है? Why you have done in this way? Why you are grossing it up? Because of interest to be paid. This is not a part of like सीधा सीधा सा है. It's a very straightforward question. How much funds required? How much cash you will pay? 410. Sorry, 412. How much cash available? 102. So this is the borrowing amount. That's it. There is no need of doing this. This was not required. Even this gain loss was not required. Why you are doing this? Was not required. Okay, 112 to fund the acquisition, they will get cash or nothing. This is not the discussion which examiner demand. You have to discuss in every possible way. What would be the concern of shareholders? Think from the shareholder perspective. Okay, EPS is rising. That is a good thing. But what would be your concern? EPS is rising. However, I think there would be additional risk. EPS is rising because of synergy. My concern is how the company will achieve that synergy. EPS is rising because company has to borrow more. For example, how company can borrow more from the market? It will increase the gearing. It will increase the risk of the company. So you have to write all those points. This is not enough discussion. This is okay. This is well written. Not 33, it's 45, 15%. This is right, but this is not enough. This you can write more. 0.38, 0.34. This is excellent answer. Has to require additional debt and also need to bear. This is excellent, excellent discussion. Look, guys, you need to write this. Annual post-tax synergies from the merger are expected to be 8 million. These figures need to be reassessed before undertaking the project. Furthermore, it is skeptical because Pymore operates in other parts of the Vestia and Mel company would need to ensure that synergy is likely to happen. So it's not like when you are discussing the concern of any party, you will not translate the your numerics into wording. No, you have to show your concern. For example, what would be the concern on the EPS? Will you able to achieve it? Will you able to achieve the synergy? Will you able to get that much loan? If you're getting that much loan, risk of shareholder will rise. So can you negotiate the loan and take a loan at reasonable rate? Okay. If you are not raising funds from the loan, if you're issuing more shares, so it is viable. Will the existing shareholder will accept this because their control will dilute? You have to write these points. This is okay. This is well written answer by the way. Excellent work.